You need a car. Two options sit in front of you: a brand new one, straight off the lot, or a 3-year-old version of the exact same model with 40,000 miles on it for almost half the price. Everyone has already told you what to think. Buying new is throwing money away the second you drive off the lot. Buying used is asking for someone else's problems. Neither of those is actually true, and neither of those is actually false. It depends entirely on numbers nobody sits down and calculates before signing anything. So we're going to calculate them for the next 8 years on both cars and follow every dollar wherever it actually goes. Here's the part almost nobody accounts for before they sign. The price on the sticker was never the real cost of either car. The real cost is what you pay to own it, drive it, insure it, repair it, and finance it every single year you keep it. Two cars with the same price tag can cost completely different amounts of money once you count everything. Keep that in mind, because by the end of this video, the sticker price is going to matter a lot less than you think it does right now. Say you buy new, $35,000 for a mid-size sedan, financed over 5 years at 7% interest. Your monthly payment lands around $690. Over the life of that loan, you'll pay about $6,600 in interest alone, on top of the $35,000 you agreed to. But the interest isn't the part that hits first, it's depreciation. And depreciation on a new car is not a myth, it's a documented curve. In the first year, the average new car loses around 20% of its value. Drive it off the lot at $35,000, and by the end of year 1, it's worth close to $28,000. By year 3, it's lost roughly 45% of its original value, worth around $19,000. You financed $35,000, and 18 months in, you likely owe more on the loan than the car is actually worth. That gap has a name. It's called being underwater, and it matters most in the exact moment you least expect to need it, if the car gets totaled and the insurance check comes in below your loan balance. I spent 20 years inside a bank pricing risk on assets that lose value the moment you take possession of them. A car is one of the fastest depreciating things most people will ever finance. The bank knows the curve before you drive it off the lot. That's exactly why the interest rate reflects it. Now say you buy used instead. Same model, 3 years old, 40,000 miles, priced at $19,000, roughly what the new car is worth by that same point anyway. You put $5,000 down and finance the remaining $14,000 over 4 years at 8%. Used car loans typically run slightly higher than new ones. Your monthly payment is about $340, less than half of the new car's payment. Total interest paid over the loan is around $2,400, but the used car doesn't come with a manufacturer's full warranty anymore. Most of those expire around year 3 or 60,000 miles, so you're taking on the used car right as that protection runs out. Say in year 2, the transmission needs work. That's a real risk with used cars, not a guarantee, but a real possibility you have to price in. A repair like that can run $2,000 or more. Suddenly your bargain isn't such a clear bargain anymore, at least not for that specific month. Here's what the depreciation curve does for you on the used side though. Because someone else already absorbed that brutal first-year 20% drop, your used car depreciates much slower from here forward, maybe 8 to 10% a year instead of 20. You bought it after the steepest part of the cliff, not during it. Insurance tells a similar story. Full coverage on the new car runs higher. Insurers price replacement cost into the premium, so you're paying more every month to insure a car that's losing value faster than the used one sitting next to it in the same parking lot. By year 3, here's where both cars actually stand. The new car. Still owe around $11,000 on the loan. Car worth around $19,000, you have about $8,000 in equity. Plus you've paid roughly $6,600 in interest total and thousands more in the extra insurance premium. The used car loan almost paid off, only about $3,000 remaining. Car worth around $15,000, giving you close to $12,000 in equity. But you also absorbed that unplanned $2,000 transmission repair somewhere in there. 8 years in, both paths land somewhere very different, and that difference tells you almost everything. The new car's loan is paid off around year 5. From that point forward, you're driving with no payment at all, just insurance, gas, and maintenance for as long as you keep it running. The used car's loan was paid off years earlier, around year 4, meaning you had 3 extra years of zero car payment before the new car buyer even got there. That gap, those extra years of no payment, is the actual number that decides this, and almost nobody calculates it. First, before comparing any prices, calculate the real depreciation you're buying into. A brand new car loses roughly 20% in year 1 alone. A 3-year-old car has already absorbed that drop and depreciates far more slowly from here. You're not choosing between 2 cars. You're choosing which point on the depreciation curve you want to buy into. Second, price the total cost of ownership, not the sticker price, before you decide anything. Add financing interest, insurance premiums, and a realistic maintenance reserve for the specific make and model, not a guess. On the new car, that's roughly $6,600 in interest, plus higher insurance for 5 years. On the used car, that's roughly $2,400 in interest, lower insurance, but budget at least $2,000 for an unplanned repair somewhere in years 2 to 4. Only once you've added all of that up, do the 2 prices actually mean anything comparable. Third, and this is the one that changes the entire outcome. Imagine you keep either car for only 2 years before trading it in. The new car buyer eats the steepest part of depreciation and trade-in fees on top of it, losing thousands beyond what the loan balance shows. The used car buyer, buying past the steep part of the curve, loses far less relative to what they paid. Time horizon changes which option wins, the same way it did with the house. Keep a car short-term, and buying used almost always protects you better. Keep it long-term, past the loan payoff, and the gap narrows significantly. Sometimes the new car catches up because you know its full maintenance history from day 1. Fourth, and this is the question that actually determines most people's outcome over a lifetime, not just one purchase. Will you keep driving this car once it's paid off, or will you trade it in for another new one in 3 or 4 years, restarting the entire loan and depreciation cycle from zero? Someone who finances a new car every 4 years, forever, never experiences a single month of their adult life without a car payment. That's not a car decision anymore. That's a permanent line item in your monthly budget for the rest of your working life, and the number attached to that habit is enormous once you extend it across decades. A mortgage eventually ends. For a lot of people, the car payment never does. 8 years out, the driver who bought used, kept the loan short, and drove the car another 4 or 5 years after payoff has spent significantly less in total, interest, insurance, and depreciation combined, even after absorbing an unplanned repair along the way. The driver who financed new, traded in at year 4, and financed new again, has paid a new interest bill and eaten a fresh depreciation curve twice over, and still doesn't own a car outright anywhere in that 8-year stretch. Neither new nor used is automatically the smart choice. New protects you from someone else's neglect and comes with a full warranty exactly when you need it most, in the early years. Used protects you from the steepest part of the depreciation curve and gets you to zero payment faster. The real decision isn't the sticker price in front of you today. It's how long you're actually going to keep whatever you drive out of that lot, and whether you let the loan end before you start another one. So tell me, are you buying new, buying used, Or are you the person still driving the same car from 10 years ago, with zero payment and no plans to change that? If it's the third one, I respect the discipline. See you in the next one.